You look great, man.
No, I thanks so much.
Good
Mark.
to be back together.
Yeah, it's been too long.
So we're in the conversation. It's all about AI, 24/7, 365. One of the topics is risk management, right?
Yes.
How is AI going to help us with risk management? What are your thoughts?
All right. The AI, and this goes back to the 80s, 90s when I used it to write programs to simulate the economy, et cetera, which all failed because the computers didn't have enough memory or processing power. I had an IBM 8086 machine with a 20 megabyte memory card.
There you go.
Yeah, it was fabulous, okay? So we were still putting floppy disks into the computer to start DOS. So it was a different era. But anyways, we lived in a world of no data. So when I want to come to a conclusion, I need 100, I'm going to say facts. But unfortunately, back in my day, I was lucky if I had 100 pieces of data. Today, everybody has, literally trillions of pieces of data. Every day, every trade on every stock exchange in this country, it's recorded. And my son who works in Wall Street has to work with that database. It is just beyond my imagination. Yet he's so comfortable with it. Me, I would never get there. So back in my day, I had 60 data points that I could use, and I needed 100. So how did I get to 100? I made 40 assumptions.
Right.
So everybody made fun of economists and forecasters, et cetera, but it's very hard to get any prediction correct when you're missing so much data. And so we always worked on building models that were very logical and solid, and leaving places to input wherever the data wasn't there. Today we have tons and tons of data, and we can optimize a system based on all of that data. The problem is, all I hear from the computer companies that sell AI systems to others is the optimization part. So I'm not sure that the AI can solve the problem. I mean, could AI have predicted that the US was going to bomb Iran in February of this year? I don't think so. And if I got an AI program that would have made that prediction, I'd have to delete it. We're not going to attack Iran. And then it happens. And you're like, okay, how did he get that right? And it's, oh, yeah, and by the way, Walter Kempsis is going to be the next president. Get rid of this crap. Okay. So the stuff that was built on mathematical principles, using truth tables, that's when you list your assumptions and logical operations on them to see what's a logical conclusion. And it's a hardcore means. Symbolic logic is the foundation of mathematics. And so, we had to operate that way. And today, we have systems that are terrific at optimizing, but they don't allow for resiliency. And that's the problem.
Explain that, Walter.
Yeah. So I build a supply chain, as I was taught at my MBA school. I'm supposed to maximize the return on invested capital, highest return I can get, and the lowest cost of capital. That's what I do. And boy, if I move my factories from the US to China, then I will lower my cost as long as the transportation cost is not bigger than the labor savings. And therefore, I'll have extra profits, and I am maximizing the the value of the firm.
Right.
And we thought this was a great idea. But then when I worked for the Department of Commerce starting in 2014, as on their advisory committee to supply chain, we had to point out that America was ridiculously dependent on China for a lot of its imports. And for example, in the area of pharmaceuticals, 98% of our pharmaceuticals and active ingredients for pharmaceuticals came from China. I didn't also study masks, but during COVID, we found out that most of our masks came from China. And when we needed them and they needed them, guess what? They didn't ship them. And so these are the risks in the supply chain that I don't think the AI is prepared to program. I mean, right now, it's kind of behind the times. All I hear from the AI companies is, well, these employees at the companies all have to learn how to input the data the same way so that we can collect that data and optimize the system. Why do we have to change the way we do things? We don't want to end up like what SAP did to many companies in the past, where they had to change from operational parameters, key performance indicators, to KPIs, key profitability indicators. And they started using financial measures to drive the managers of the actual business, the operations of the business. It's true, the KPIs and the other KPIs should line up. They should tell the same story. But it doesn't mean that you can use the financial ratios to manage the company. And so there was one big chocolate maker who way back in 93, 94 had way too little candy on the shelves for Halloween. And they apologized. They had just installed SAP, and they apologized and apologized. And they got to Christmas, and guess what? They still didn't have enough candies on the store shelf. So that's when the dismissals came, right? Because at that point, the share price tanks. The board of directors calls the CEO, and the CEO says, okay, as usual, something flows downhill. So go find some people responsible for this. The bottom line is that the optimization of a system does not mean that you have included resiliency. In the financial markets, we have a risk-return trade-off. The higher the return you seek, the more risk you have to take on.
Right.
And so we have learned how to optimize the construction of a portfolio of stocks and bonds to get to the best risk-return ratio that we want. In the supply chain industry, people don't understand nonlinearity. To them, it costs so much to move the box from the factory in China to Shenzhen, to ship it from Shenzhen to Los Angeles, to ship it from Los Angeles to Chicago, and then from Chicago to a DC, and then to the warehouse. Add up all of those costs, it's nice and linear. And what if this goes wrong? Well, then we find another trucking company, ocean carrier, whatever.
LA strikes.
Exactly. So LA strikes come up, right? In 2002, the lockout. Most recently, the Iran conflict. Before that, COVID. And the AI can't predict that, but it doesn't design. What we're not seeing is designing for that. What we're seeing is the AI companies complaining that everybody must stop using Excel and put their data in a format with our software, because then we can take it from there. The problem is because the Chinese hackers, the Koreans, the Russians, they can get into my computer and ransack all that data, sort it out, and pull out of it what they need in order to steal my identity. Now, they can do that. Our IT AI companies are like, well, you all have to put the data in the exact same format for the system to work. You are not good at what you do if that's the case. It should be that the company has access to all the employees' files, data files, and they can pull out of those data files the same way the Russians, the Chinese, the North Koreans, and Iranians do on a regular basis. And we don't have that yet. And so I think we're always going to have a bit of a data lag. And because of that, you can't try to do the risk-return optimization in your supply chain design. And what does that mean? More resiliency. How do you build it, to get you the highest return per unit of risk? You want the lowest possible cost, you'll get a huge return. But man, good luck. All it takes is a couple of clouds and some rain, and your fair day optimization went out the window.
Significant risk associated with that.
Exactly. So, but anyway, it's obviously something that I've spent a lot of time talking about. I've had clients who've asked me to help them optimize their supply chain for resiliency. And the conversations I've had at 3 major conferences I've been at, Prologis had their innovations seminar. It was fabulous.
This was last week, right?
3 weeks ago.
Okay.
And then the last week was Masters Supply Chain after that. And then it was SCLA, which is where I was this last week. And, absolutely, really fabulous conversations. But it's all around what I learned from them is that Wall Street has come to accept that companies are going to have higher logistics costs because they need the resiliency. It's kind of like what's been going on is we have spent 30 years building up this economy, importing stuff from Asia. Great. And it's the same thing as having built a house and never bought fire insurance. Hey, look, I saved a lot of money. Look, Wall Street, I'm making high earnings. Yeah, you didn't buy the house insurance. If your house burns down, you lose everything. And that's my best analogy, Mark, for what I think is going on, is that people who aren't buying insurance, and Wall Street encourages them not to buy insurance, they're the ones who are going to burn down. And so when I look at companies and I think about companies, I ask myself, are they paying for a reasonable amount of resiliency?
You've got to.
Exactly.
To be prudent, to protect the overall investment. You've got to. More to come on this topic. Walter, it's always great being with you, man.
Yeah, absolutely, Mike. Hey, y'all, take care.
Have a good day.